So good morning, class. Good morning. How is your weekend? How was your weekend? So today we shall be looking at taxation of merger and acquisition. Taxation of merger and acquisition. That is the topic we are looking at today. Taxation of merger and acquisition. So we will discuss merger, we discuss acquisition, we discuss partnership, we also discuss business reorganization and reconstructions. So those are the areas we are going to discuss this morning. And we are also going to look at the tax implication. We are going to look at the tax implication. First, what is merger? We start with what is merger. Merger is a form of business combination where two or more companies join together to become one enlarged surviving company. Merger simply means a business combination where company A and company B, they join together. They now become a new company called company C. That is meaning of merger. Company A and company B, they join together to become a new company called company C. Two or more companies, they come together. In merger, A is going to lose its brand. B is going to lose its brand. So they will start another brand called company C. That is the whole essence of merger. Now, what is acquisition? What is acquisition? What do we understand by acquisition? Acquisition means a business arrangement where the asset and liability of one company is acquired by another company. Acquisition is a business arrangement where asset and liability of one company is acquired by another company. In acquisition, A is going to acquire B. A is going to acquire B. That means A will still continue his business operation while B will cease operation. But in merger, when A and B, company A and B merge together, company A will cease operation, company B will cease operation. They will now form a new company called C. That is merger. That is merger. So, but in acquisition, A is a business arrangement where asset and liability of two or more companies is acquired by another company. Example, A acquired the asset. So that is meaning of acquisition. Now, let's look at type of merger. What type of merger do we have? There are two types of merger. We have horizontal merger and vertical merger. Horizontal merger and vertical merger. Horizontal merger simply means a situation whereby two or more companies in the same line of business merge together, come together to form a new company. That is horizontal merger. Example, where Chartered Bank and IBTC Bank merge together to become a new company called Standard Chartered Bank. That is horizontal merger because they are in the same line of business. They are in banking business together. So where GTB and Access Bank merge together to form a new bank. That one too is horizontal merger. That is horizontal merger. So the next one is vertical merger. Vertical merger. What is vertical merger? Vertical merger is a business combination where two or more companies in the same industry, but they are in different line of business. They merge together to become a new company. Vertical merger can be backward in forward, that is vertical merger. Now, benefits of merger and acquisition. What is benefit of merger and acquisition? What benefit do we tend to achieve from merger and acquisition? Number one benefit is there will be improved management. There will be improved management. Another one is increase in economic of scales. Number one, which is improved management. If two or more companies merge together to form a new company, the management will improve. The management of the company will improve. There will be management efficiency because there is a new management in place. The management is going to improve. There will be management efficiency. That is number one benefit of merger and acquisition. Another benefit is operating economies. Operating economy or economic of scales. Somebody is asking whether the material I've shared it. I've shared the material since last week Sunday. You can just go to your WhatsApp, scroll down, you will see the material. So economic of scales. So merger will result into economic of scales. Economic of scales simply means when two companies merge together to form a new company, they will produce more. There will be increase in productions. Assuming each of them is producing 20,000 units bag before. But when they merge together now, they will be producing more. They will be producing more. That is economic of scales. Merger will also result into company growth. The company will grow. The new company that merge together or the new company that acquire another company will grow. Is going to grow. Another benefit of merger is increase in market power. The company will have better competition edge. When two companies merge together to become a new company, it will make them to compete. It will make them to do more competition against another company. It will make them to have market shares. Increase in market power means market shares. They will have more market shares in the market. They will dominate the market. So if two companies merge together, or if another company acquire another company, that company that acquire will have more power. It will have more market shares. It will dominate the market. It will have opportunity to do competition with the other company in the industry. That is another benefit. Improve financing. Improve financing. If two companies merge together to become a new company, there will be improved finance. There will be more capital. The capital base of the company will improve. The new company that they just formed, their capital base will be more. It will be improved. So they can do a lot of business. Another benefit of merger, diversification and risk reduction. merger will result into risk diversification or reduction of risk. You are merging together, A and B merging together, that means they are spreading their risk. They are spreading their risk. Instead of the risk to be on one company, it's already spread. So, and it will reduce the risk in the long run. It will reduce the risk in the long run. Another one we fail to mention, which is benefit of merger, is profit shareholder. Shareholder too will benefit from merger or acquisition. The shareholder will benefit. So the other one is shareholder wealth maximization. Shareholder wealth maximization. So there will also be profit maximization. There will also be profit maximization. If two companies merge together to form a new company, these are benefit of merger and acquisition. These are benefit of merger and acquisition. Now, the major area that concern us, this is advanced tax. We are in tax class. We want to look at tax implication of merger. Tax implication of merger. If a company want to merge together, first thing is they must write to if A and B want to merge together to become C, they must write letter to FRS to seek FRS consent about the merger. And the two companies merging now, they are going to see separation. So they need to collect clearance from FRS that they are not owing any outstanding tax. So that means FRS need to give them clearance. So in detail, we can now look at tax implication of merger. So what do we call merger? Like I said, merger means a situation where company A and B merge together to form another company called company C. We can refer merger as another situation whereby a new company take over an existing company. So you can be asked, what is tax implication of merger? Or you are asked, what is the tax implication of a new company taking over an existing company? How do we conclude that merger is a new company taking over an existing company? In merger, there will be 3 companies will be involved. A and B, they are the one merging together. They want to form a new company called company C. That company C is a new company. A and B is an existing company. So company C is taking over what? An existing company. So you may be asked, what is the tax implication of a new company taking over an existing company? They are referring to what is tax implication of merger. What is the tax implication of merger? That is what they are referring to. Now, let's look at the tax implication one by one. In the case of merger, number 1 tax implication is the old company, which is company A and B, they are the old company, is deemed to have ceased business, while cessation rule will apply to the old company. A and B, they are the one merging together to form C. A will cease business, B will cease business. By ceasing business, if you want to complete the task in the day that they merge together, we are going to apply what rule? What rule are we going to apply? Cessation rule. That means completing the task in the date of merger, we apply what is called cessation rule. So cessation rule we apply to the old company. Now, another tax implication, number two tax implication is the new company is deemed to have commenced business, and commencement rule we apply to the new company. That means company C that was just formed in the first year of company C, we are going to apply commencement rule to compute the tax of the profit of company C. We are going to assume that company C commence a new business, and commencement rule we apply to company C. Another tax implication of merger, filing of annual return. The new company, which is company C that was just formed, the new company will be required to file annual tax return within 6 months after the end of the first accounting year, or within 18 months from the date of what? From the date of commencement. That is what the number 3 is saying. The new company will be required to file their audited accounts, which is the tax return with FRS, within 18 months from the date of commencement, or 6 months after the end of the first accounting year, whichever is earlier. That is another tax implication. Another tax implication of merger in the area of claims of capital allowance. That is, let's look at it in the area of claims of capital allowance. In the area of claims of capital allowance, the qualified capital expenditures of the old company, which is company A and B, is going to be transferred to company C at what? At tax written down value. The qualified capital expenditure of company A and company B will be transferred to the new company, which is called company C, at what value? At tax written down value. And initial allowance will not be claimed. Initial allowance will not be claimed by company C. Only annual allowance will be claimed by company C. And the annual allowance that will be claimed by company C will be based on remaining useful life of that qualified capital expenditure. Let me repeat myself again. Number 4 tax implication of merger we want to look at is claims of capital allowance. In the area of claims of capital allowance, we said the qualified capital expenditure of company A and B is going to be transferred. It's going to be transferred to who? Company C. At what value? Is it at cost? No. It's going to be transferred at tax written down value, TWDV. And initial allowance will not be claimed by company C. Only annual allowance will be claimed. And the annual allowance is going to be claimed based on what? The remaining useful life of the assets. That is another tax implication. Another tax implication we should look at in the area of stamp duties. In the area of stamp duties, stamp duty payment arising on increase in share capital as a result of merger. You know, when two companies merge together to form a new company, A and B merge together to form a new company called Company C. The capital structure of Company C is going to be allocated to Company A, is going to be also allocated to, part of it to be allocated to Company B. So Company C will have a new capital structure. That capital structure, there will be need to register the new capital structure with the Corporate Affairs Commission. And while in the process of registering it with the Corporate Affairs Commission, there will be need for payment of what? Stamp duties. There will be need for payment of what? Stamp duties. There will be need for payment of a tax called stamp duties. They will pay a tax that is called stamp duties. So increase in share capital as a result of merger will attract payment of what? Stamp duties. Another tax implication. Another tax implication. Merging costs. Merger costs. In the process of merger, the company will need to spend some costs like professional fee, because when two companies want to merge together, they have to engage a lot of professionals. Estate valuer will help them to value their assets, their land and building. You understand? Accountant will help them to prepare their accounts. Lawyer will help them to prepare the legal agreement. So they will engage some professional. Those costs paid to the fee paid to the professional is merger costs, and those merger costs will be incurred by either Company A or Company B, or is now transferred to Company C. But in essence, that merger cost will be treated as preliminary expenses and is going to be disallowed. It's going to be classified as disallowable expenses while computing adjusted profit of the new company. So merger costs paid to the professional, accounting fee, estate valuer fee, legal fee will be treated as preliminary expenses and will not be allowed for tax purpose. That means it's going to be treated as a disallowable expenses. Another tax implication of merger. Value-added tax and withholding tax will be the professional fee paid for service rendered in connection with merger. The professional fee paid for service rendered in connection with merger is going to attract the professional fee paid in connection with merger is going to attract the professional fee paid in connection with merger is going to attract value-added tax and withholding tax. While paying professional fee like audit fee, accounting fee, it will attract withholding tax. It will also attract value-added tax. The professional fee paid in connection with merger, we attract value-added tax and withholding tax. Another tax implication of merger. Unrelieved capital allowance at the case of cessation. If any of the company, either company A or company B, have unrelieved capital allowance at the date of cessation, such kind of capital allowance will be carried backward for maximum of 5 years and is going to be set off against profits. In the preceding year. If any of the merging company have unrelieved capital allowance, either company A or company B, if any of them have unrelieved capital allowance, the capital allowance can be carried backward and set off against accessible profit for the maximum of 5 years. Preceding year accessible profit. My colleague, while discussing capital allowance, he will have talked about capital allowance carry backward. Do you understand capital allowance carry backward? Do you know how to carry capital allowance backward? Hello? Have you come across capital allowance carry backward while solving capital allowance question?
No, sir.
No.
Huh?
No, we haven't.
I can't hear you.
No, I haven't.
Okay. So there is something called capital allowance carry backward. So we can only carry capital allowance backward. We can only carry capital allowance carry backward for maximum of 5 years. And we set it off against the profit of preceding year. So that is capital allowance carry backward. We also have another tax implication of merger. Another tax implication of merger that we can look at is the area of unrelieved losses. At the date of cessation of either company A or company B, if they have unrelieved losses, the unrelieved losses cannot be carried backward. The unrelieved losses can only be set off against accessible profit of preceding year. Cannot be set off against accessible profit of preceding year. That means unrelieved losses at the date of cessation cannot be carried backward. You understand? That unrelieved losses at the date of cessation will be treated as terminal loss. That means you cannot claim that loss again. So if company A and company B, they are merging together to become company C. If either company A or company B has unrelieved losses, any of the company that have the unrelieved losses cannot carry it forward. Rather, it cannot carry it backward too. That means that unrelieved losses at the date of cessation will be treated as terminal loss. That means that loss is a final loss which you cannot claim against any profit. That is another tax implication of merger. So we have mentioned a lot of points in this tax implication of merger. We mentioned like 10 points. So please, let's try and know them. Number one of the point is tax implication of merger is the old company is deemed to have 6 business and cessation rule will apply to them, while the new company is deemed to have commenced business, commencement rule will apply to them. That is number 2 point. Number 3 point is the area of filing of return. So the new company is expected to file return within, is expected to file return for company income tax purpose. That means within 6 months after the end of the first accounting year, or within 18 months from the date of commencement of business, whichever is earlier. So whichever is earlier. So that is another tax implication. Another one. So another one. We also said in the area of claims of capital allowance, we only say that the taxing down value, the qualified capital expenditure of the old company is going to be transferred to the new company as tax written down value, and no initial allowance will be claimed. Annual allowance will only be claimed based on the remaining useful life. We also talk about the issue of stamp duty. We said increase in share capital from the new company as a result of merger is going to attract payment of stamp duties. We also talk about the merger cost. That merger cost incurred during the process of merger is called preliminary expenses and will be treated as a disallowable expenses while computing adjusted profits. We mentioned that too. We also talk about professional fee paid in connection with merger. We attract value-added tax and what? Withholding tax. We also talk about the area of unrelieved capital allowance at the date of cessation for any of the two merging companies. We only shall be carried backward for maximum of 5 years on a preceding year of cessation. And we also talk about unrelieved capital allowance at the date of cessation for any of the two merging companies, either company A or company B. That unrelieved capital allowance, you cannot carry it forward and you cannot carry it backward. That means that unrelieved capital allowance will be treated as terminal loss. That means it's final loss. That is tax implication of merger. Now, let's look at tax implication of acquisition. Tax implication of acquisition. What is tax implication of acquisition? So, number one, tax implication of acquisition. Tax implication of acquisition. Another way I can normally ask question on tax implication of acquisition is, what is the tax implication of two existing companies? Tax implication of an existing company absorbing another existing company. You know, in acquisition, there is absorb. Absorb means acquire. Acquisition, it involves two companies, A and B. It can involve more than two companies, but in my own example, maybe it involves two companies, A and B. Company A want to acquire company B. You understand? Company A is the absorbing company, while company B is the absorbed company. In past question, when they want to ask tax implication of acquisition, they can ask this in another way. What is the tax implication of an existing company taking over another existing company? That means, what is the tax implication of company A is taking over company B? An existing company absorb another existing company. What is the tax implication? So it's the same thing as tax implication of acquisition. Number one, the company absorb, which means company B, A acquire company B. The company absorbed will be deemed to have ceased business and cessation rule will be applied. Company B will be deemed to have ceased business and cessation rule will apply. Company B will be deemed to have ceased business and cessation rule will apply. The company that absorbed, which is now company A, will not be deemed to commence business. You know, if A acquire company B, A is not going to lose his brand, but B will lose his brand. A will still be bearing A company A limited. Unlike merger, if A and B, company A and B merge together to form company C, there will not be, none of the company will be bearing their name again. They will now be bearing a new name, C Limited, company C Limited. But in the area of acquisition, if A acquire B, it is B that will lose his brand. A will still maintain his brand. A is still going to maintain his brand. A will still be bearing his own name. So number 2 tax implication simply means the company that absorbed will not be deemed to have commenced a new business. The company that absorbed will not be deemed to have commenced what? A new business. That means commencement rule will not apply to company A. We will not assume company A commence a new business. No. We assume that company A continue with his old business. It's just that it acquire another company. It increases asset base. So commencement rule will not be applied to company A. Another one, the surviving company, which is company A, will not be entitled to initial allowance or investment allowance on the asset transfer. The annual allowance will be based on tax written down value. That means if company A acquire company B, the qualified capital expenditure, which is the asset of company B, will be transferred to company A at tax written down value. And initial allowance will not be claimed. Annual allowance will also be claimed based on what? Tax written down value, based on the remaining useful life. Another tax implication of acquisition. The unabsorbed losses and capital allowance of the company of the absorbed company, the unabsorbed losses and capital allowance of the absorbed company, the unabsorbed losses and capital allowance of the absorbed company will not be carried forward and cannot be set off against profit of the surviving company. That means if company A, if company B has unabsorbed losses or unabsorbed capital allowance, that unabsorbed losses and capital allowance of company B cannot be transferred to company A that acquire company B. You understand? It cannot be transferred to company A that acquire company B. That is what this one is saying. Another tax implication of acquisition. While company A acquire company B, they may also engage professional. That means fee payable to professional service in connection with the acquisition will be subject to what? Value added tax and withholding tax, as it was stated in the acquisition. As it was stated in the merger. So that is another tax implication. Another tax implication is when A acquire B, there will be increase in share capital of the surviving company. Increase in share capital of the surviving company. The increase in share capital of the surviving company will attract payment of what? Stamp duty. The increase in share capital of surviving company will attract payment of what? Stamp duties. It's another tax implication. Another tax implication of acquisition is when A acquire B, if B, the purchase consideration paid to company B by company A, company B can make gain. They can make gain on the purchase consideration. How will company B make gain? If the purchase consideration is higher than the net assets. If the purchase consideration is higher than what? The net assets. That means there is a gain. That means there is a gain, there is a goodwill. Goodwill, company B will pay capital gain tax on it. The goodwill, the gain received by the absorbed company as a result of acquisition will be subject to what? Capital gain tax. So if A acquire B and the purchase consideration B make a gain, when you compare the purchase consideration with the net assets of B, B now make a gain. The gain that B make is going to pay a tax called capital gain tax on that gain. That goodwill is going to pay capital gain tax on it. So that is another tax implication of acquisition. That is another tax implication of acquisition. So we have talked about tax implication of merger. We have talked about tax implication of acquisition. The next tax implication we need to talk about is called tax implication of reconstituted companies. Tax implication of reconstituted companies. What is the company? Then we need to know the meaning of constituted company first. What is the meaning of constituted company? Reconstituted company means those companies that was previously owned by foreigners or is owned by foreign companies, and later they now transfer it to a local companies. That means those companies in which their shareholding structure is owned by foreigner, and yes, then now reconstitute the shareholding structure because of some government policy. Government now said, foreign company cannot own 100% shares in a company in Nigeria. Part of your shares, so you need to sell it to some local citizen, some citizen of Nigeria. You need to sell part of your shares. So that means part of your share will be owned by Nigeria. That is a reconstituted company. It is a reconstituted company. That means the company, there is change in the shareholding structure. The company still bears the same name. It's still carrying on the same operation, but there is just a change in the shareholding structure. Some of the shares has now been given to the Nigeria citizen. The share is no more fully owned by foreigner. That is meaning of the constituted company. So we want to look at the tax implication of reconstituted companies. Number one tax implication of reconstituted company is commencement to and cessation rule will not be applied to the reconstituted company. The company does not change business. It's not acquired by a new person. It's just that they just increase their investors. Some new shareholder was admitted. So commencement to or cessation rule will not apply to the reconstituted company. That is number one tax implication of reconstituted company. Another tax implication of reconstituted company is the asset vested in the reconstituted company shall be deemed to have been sold. That means after they reconstitute the company, the assets that the company owned before they reconstitute them shall be deemed to have been sold to the new reconstituted company. And in that case, the qualified capital expenditure will be based on residual value. That is what this number 2 point is saying. Number 3, the reconstituted company shall not be entitled to initial allowance on the assets, on those assets. Shall not be entitled to initial allowance. And capital allowance, if they want to claim capital allowance, they will only claim annual allowance. That means the assets will be transferred at tax written down value. Another tax implication, unrelieved losses of foreign company on the date of reconstitution. Unrelieved losses. On the date of reconstitution, if the reconstituted company has unrelieved losses, the unrelieved losses shall be carried forward to the reconstituted company after reconstitution and can be used to offset the profit of the first year, in the first year of assessment after the reconstitution. What we are saying is, before reconstitution, the company have unrelieved losses. After they now reconstitute, that unrelieved losses that they have before reconstitution will be carried forward to after reconstitution. And when they carry it forward after reconstitution, they can relieve it against profit of the first year of assessment after reconstitution. They can relieve it against the profit of the first year of assessment afterwards the constitution. And if they want to relieve it against the profit of the first year of assessment after the constitution, they must seek the consent of FRS. They must seek what? The consent of FRS. That means they must seek the permission of FRS that they want to claim a losses that they have before they reconstituted. So that is tax implication of reconstituted company. Another one we can look at, what is the tax implication of business reorganization or restructuring? Business reorganization or restructuring. We can look at that. We have that too. But the major one we need to know under business reorganization or restructuring is about the issue of surrender of shares. Surrender of what? Shares. Under business reorganization or restructuring, what we need to know there is the issue of what? Surrender of shares. When you want to sell part of your shares, you own a company, you want to sell part of your shares of your company to new investors. Do you understand? That share you are selling to new investors, or business reorganization means business that they change in the mode of operation. There's change in the management. In a business reorganization, some new investor may come to take over the company. Those old investors will be given shares in the new company that they just reorganized. The question is, if the old investor sell their share and they receive cash, they pay them for selling their shares. If they make a gain from selling the shares, they will pay capital gain tax. But if the old investors does not sell their shares in the business reorganization that they just reorganized, they were given another shares. That means if, take for instance, before reorganization, the share value of the old investor was 20 million. After reorganization, they now give them a new share that worth 50 million. That shares given to them that worth 50 million, they have made a gain on the shares, different between 20 million and 50 million. They will not pay capital gain tax since they are not collecting cash. Assuming they are collecting cash, they will pay capital gain tax. That is the major issue on business reorganization. Those are one of the major issues on what? Business reorganization. And when business reorganize, they may reorganize because of tax concession. As a result of reorganization or restructuring, there may be some tax concession given to them. What are the tax concessions that will be given to business that reorganize? That means commencement rule and cessation rule will not apply to business reorganization. Is one of the tax concessions. And again, in the area of capital allowance, the assets sold or transferred shall be deemed to have sold for an amount equal to residue of the qualifying expenditure. That means in the process of business reorganization, if the qualified capital expenditures have some tax written down value. If they now sell it to the new management as a result of business reorganization, the new management cannot claim annual allowance or initial allowance on that asset. We assume that the asset is held as what? Residual of the qualified expenditure. That means it's said at the value that remains after the expiration of the tax life of the assets. After the expiration of the tax life of the assets. So that is what they are trying to talk about on this business reorganization or business restructuring. The last part of tax implication we need to look at under merger and acquisition before we go to the calculation is what is the tax implication of conversion of partnership business to what? Limited liability company. Tax implication of conversion of partnership business to limited liability company. If we are converting a partnership business to limited liability company, let me give an example. ABC and Co is a partnership business. After some number of years, the partner, they are now aging, they are growing old. The three partners, they are in their late 60s. They will be thinking of succession planning, and none of their children is willing to take over. For the business not to cease after their demise, they may think that, oh, this ABC and Co, let's convert it to a limited company so that more people too can have shares in it. That means they want to convert ABC and Co to a limited company called ABC Limited. So what is the tax implication of converting partnership business to limited company? So what is the tax implication? That is what we want to look at today. That is the last part we want to look at. Number one tax implication of conversion is cessation rule we apply to the partnership business, and profit arising from that cessation will be subject to what? What type of tax? Personal income tax. You know, partnership business pay personal income tax. They are not paying company income tax. So that partnership business, ABC and Co, at the date of conversion, cessation rule will apply to them. And profit arising from such cessation is going to be subject to what type of tax? Personal income tax. Another one, another tax implication. Commencement rule we apply to the new limited company, ABC Limited. Commencement rule is going to apply to them. And profit arising from the commencement of business of that new company is going to be subject to what type of tax? Company income tax and education tax. Commencement rule we apply to the new limited company, and profit arising from the commencement of the business will be subject to what type of tax? Company income tax and education tax. Another one, another tax implication. The incorporation expenses incurred by the new company will be treated as the salariable expenses. ABC Limited will incur some incorporation expenses. That ABC Limited, one of the incorporation expenses it will incur, there will be need to go and register ABC Limited with Corporate Affairs Commission so that they can allot shares to the new shareholders. Partner A, we also have shares in ABC Limited. Partner B, we also have shares. Partner C, we have shares. Maybe they can invite more shareholders, some new shareholders. So what we are saying in essence is those incorporation expenses like registration of company is going to be treated as what? Disallowable expenses while computing the tax liability of ABC Limited.
Question, sir.
Is it clear enough?
Hello, sir.
Hello?
Okay, sir. These incorporation expenses, they are disallowable expenses because they should be
Are you with me?
capital.
Is it clear enough?
I can hear you. Can you hear me, sir?
Yes, I can hear you.
Okay, so I want to ask a question. These incorporation expenses, they are disallowable expenses. I say, are they
Yes.
disallowable because they should be capitalized?
Yes, they are disallowable because they should be capitalized.
Okay, thanks. Sir.
Another tax implication of conversion of partnership business to limited liability company. The new limited liability company, ABC Limited, will be required to register with FRS for company income tax and value-added tax payment within 6 months from the date of commencement of business. That ABC Limited is going to be required to register with FRS for the purpose of VAT and company income tax payment within 6 months from the date of what? Commencement of business. FRS will issue TIN number to the new limited company, ABC Limited, for payment of company income tax, education tax, value-added tax purpose. So when they commence business, the law requires them that within 6 months from the date of commencement, they should go and register with FRS. Another tax implication. The professional fee paid in respect of conversion will attract withholding tax and value-added tax. The professional fee paid in respect of conversion will attract withholding tax and value-added tax. Another tax implication. The partner capital, the capital of the partner will be converted to what? Ordinary share capital. You know, when they are in ABC Limited, their capital is called partner capital. Now, when they are in ABC and Co, their capital is called partner capital. Now they are now called ABC Limited. The capital can now be referred to ordinary share capital, and stamp duty will be paid on the shares allotted to the partners in the new companies. Stamp duty is going to be paid on the share allotted to the partner in the new companies. These are the tax implications of conversion of partnership business to a limited liability company. Now, let's look at the question. Examinable question 1. Examinable question 1 is calculation. I'm going to treat that. Examinable question 2, examinable question 3, examinable question 4. They are theory. I will advise us to go and study that examinable question 2, 3, 4. They are theory, but they may be likely one of our exam questions. Advanced tax is more of theory than calculation. Advanced tax is more of theory than what? Calculation. Sometimes 50% theory, sometimes 50% calculation. Why sometimes 60% of the question will be theory, while 40% will be based on calculation. So let's pay more attention to theoretical part of the question. So I want to do examinable question 1. I'm now giving them as an assignment. Examinable question 2 is theory. Answer is there. After the class, take your time, study it very well. Examinable question 3 too. Study it very well. Examinable question 4. Take your time and what? Study it very well. So those 3 questions, let's take our time to study those theory questions very well. They are very important. They are one of the likely exam questions. So they are one of the plus of the marker in the question in the exam. So let's take our time and study very, very well. So let's look at examinable question 1. Let's look at examinable question 1. Examinable question 1. Let's look at them. Somebody should help us read the examinable question 1. Somebody should help us read.
Okay, I'm going to read. Examinable question 1. Akorede Limited and Tope Limited combined their assets and operations to form a merger in the name of a newly registered company, Fine and Beauty PLC, acquired the assets and operations of Akorede Limited and Tope Limited on 30/7/2023 and declared to prepare accounts to 31/12 annually. Akorede Limited that usually prepares accounts 39 of every year had the following results. So gross profit 2020, 2022 ending 30 July 2023. Deduct depreciation and impairment charges, VAT on purchase, add profit on sale of assets. Sundry income, interest on government bond, interest on National Development Bank, net profit. Tope Limited, which prepares account to 31/06 of every year, had the following results. Gross profit, deduct depreciation, repairs, management expenses, VAT on printing, add sale of scraps, sundry income, interest on investments, dividend received, net profit. Fine and Beauty PLC commenced business on 1/8/2023 and makes profit. Profits, initial allowance, annual allowance. 5 months net profit to 31/12/2023. 12 months net profit to 31/12/2024. 12 months net profit to 31/12/2025. You are required to compute A. Adjusted profit for Akorede Limited and Tope Limited. B. Tax liabilities for the 3 companies.
Thank you very much. So hello, can you hear me?
Yes, we can hear you now.
Okay. Now let's compute adjusted profit for Akorede Limited. I'm asking my people, if you are asked to compute adjusted profit, what is the first item you need to write? Net profit. When you want to compute adjusted profit, you write the first item, net profit, Abi?
Yes.
You are going to add back what?
Disallowable
Add
expenses.
back disallowable expenses. And you are going to less what?
Allowable expenses and non-taxable income.
You are going to less non-taxable income, or you less allowable expenses omitted. So let's go to this question. The net profit of Akorede Limited is given for each of the year. For year one, which is 2020, the net profit of Akorede Limited is 603. Year two, 602, 500. Year four, 289. Year five, year three, 289. Year four, 356. Add back the disallowable expenses. Let's now look at the expenses of Akorede. We will now ask ourselves, is it allowable or disallowed? Those expenses that have been used, that has been deducted from the gross profit to arrive at the net profit. Let's go and look at those expenses one by one to know the one that is allowed among them, to know the one that is disallowed. Depreciation. Depreciation. Is it allowable expenses or disallowable expenses?
Disallowable.
Is disallowable. That means the first item you are adding back to the net profit is depreciation. It is disallowable. Thank you. Depreciation is disallowable. Administrative expenses. Is it allowable or disallowable?
Allowable.
It is allowable. Any other person? Any other person? I want the class to be interactive. You have started company income tax. Mr. Christopher is allowable. Thank you. What of impairment charges? Is it allowable or disallowable?
Disallowable.
In your corporate reporting, you normally make provision for impairment, revaluation, something like that. In tax, we don't know impairment. Oh. We treat impairment as depreciation. So because we are asking a question, who do you pay the impairment? When you say there is impairment loss on one asset, who do you pay? Nobody. That is our perspective in tax. So it is a decided anything, revaluation, impairment, as a result of all this your IAS or IFRS, we don't recognize them in tax. The expenses we recognize in taxes, those expenses that you incur for business, and we can see that you actually pay the third party. Do you understand? Any expenses you don't pay the third party, we can't recognize them. It's not allowed. So that means impairment charges is also treated as a disallowable expenses. Another one, VAT on purchases is another expenses under our expenses. VAT on purchases, is it allowable or disallowable?
I don't know why we have VAT on purchase here. If this is income statement, how come we have VAT on purchase on the income statement?
It's part of income statement. So in the expenses, there is VAT on purchases. We purchase goods, the VAT that we paid on those purchases, is it allowable or disallowable? Is it allowable or disallowable?
I expect VAT to be treated against the output VAT, and then the net.
Okay. So let me give you a small lesson of VAT. Let me open an Excel. I want to give you a clear illustration on treatment of VAT in tax, just within 10 minutes, within 5 minutes, so that when we see VAT in an expenses, we will know which one we should allow, which one we should disallow. I'm coming. Let me share an Excel. Okay, this is an Excel. In VAT, we have VAT on sales, VAT on sales. VAT on sales is otherwise called what?
VAT output.
VAT on sales is
Output
otherwise
VAT.
called
Output VAT.
output VAT. VAT on sales is otherwise called output VAT. We have that already. Another one that we have, we have another one called VAT on purchases. VAT on purchases is otherwise called what? Who can tell me? Input VAT, Abi?
Input VAT.
We now have another VAT. VAT on expenses. VAT on what? Expenses. Example of those expenses that VAT attracts: printing and stationery. Printing and stationery. Telephone. Internet. Repairs. They are all VAT on what? Expenses. These are all VAT on expenses. These are VAT on expenses. What we are saying in essence is VAT on output VAT to company is a revenue to them, but they need to remit it to tax authority. Abi? Do you agree with me? Company that make a sales,
Yes.
the output VAT they charge is coming as an income to them, but they will remit it to tax authority. Abi?
Correct.
While remitting it to tax authority, they will minus input VAT from it. That means output VAT, they will now minus input VAT.
Yes.
From it. Abi? You understand? It is the balance that they will remit to tax authority. So this has been dealt with under value-added tax already. But if in the expenses, you now see VAT on printing and stationery. VAT on printing and stationery is an input VAT too. But the input VAT on printing and stationery cannot be used to offset output VAT. Do you agree with me? Do you agree with me? The input VAT on this printing and stationery we are looking at, it cannot be used to offset output VAT. Do you agree with me?
Because it's an expense.
Yes.
It's an expense. Yes, sir.
Okay. Yeah.
Likewise, too, input VAT on telephone and postage cannot be used to offset output VAT.
No, it
so
cannot.
in the expenses, when we now see input VAT on printing and stationery, telephone and postage, internet, repair and maintenance, since they cannot be used to offset output VAT, we treat them as unallowable expenses. Why in the expenses, if we see input VAT on purchases, are you going to allow it or disallow it?
Allowed.
You will disallow.
Input VAT on purchases.
Yes. Why do you disallow? Who can tell me why I disallow it?
Okay, because
it can be used to offset.
it can be used to offset
output VAT. It has been used to offset output VAT. Do you understand? Another way they can set VAT in an exam, they will say VAT on assets. VAT on what? Assets. They will put it as an expenses. VAT on assets. They will put it as an expenses. Example, you buy motor vehicle, VAT on MV, motor vehicle, or VAT on equipment. VAT on equipment. You buy that. You will see it as an expenses. All these VAT on assets. While you buy an asset, the VAT on the asset should be capitalized to the cost of the asset. Do you agree with me? In line with IAS 16.
Yes.
VAT on assets should be capitalized. So if you see VAT on equipment, or VAT on land and building, or VAT on printing on plant and machinery as an expenses, are you going to allow them or disallow them?
Disallowed.
You will disallow them because they will be capitalized to the cost of the assets. Do you agree with my submission?
100%.
That is how they treat VAT. In advanced tax, in your expenses that they will give you, you will see VAT there. ICAN normally tested VAT as part of expenses now. It's now left for you to know that, am I going to allow this VAT or disallow it? The only VAT I will allow is VAT on expenses. And you should have it in mind, the VAT on expenses you are allowing, that expenses must be allowable expenses. Do you agree with me?
Yes.
If they go and pay VAT on disallowable expenses, are you going to allow it?
No.
No. So you should know that on VAT. Hope my point is clear on VAT.
Yes.
Another area we should look at is another one called stamp duties. Stamp what? Duties. In some expenses, if they want to ask you to compute adjusted profit, they will say, stamp duties. Stamp duties on telephone and postage. Stamp duties on printings. Stamp duties on share capital. Stamp duty on share capital. Stamp duty on share capital. And another one. There is another one called stamp duties on equipment or any of the assets. Stamp duty on equipment or any of the assets. My question is, all these stamp duty I mentioned, which one do you think it should be allowed as an expenses? Which one is going to be allowed as an expenses?
Okay.
Telephone and
printing
is an allowable expenses. Printing and stationery is an allowable expenses. Its own stamp duties too is going to be allowed.
Yes.
It's going to be allowed. Its own stamp duties too will be allowed. But share capital is not an expenses. If you pay stamp duty on it, you cannot allow it. The equipment too is not an expenses. If you pay stamp duty on it, you cannot allow it. Do you understand?
Yep.
Please, sir.
So,
Hello, sir.
yes.
If the
Yes, I can hear you.
If the examiner just takes stamp duties without qualifying it, How do we treat it, sir?
You disallow it.
Okay, sir.
You disallow it. So let's go back to our question. Let's go back to our question. Now, this VAT on purchases, are we going to allow it or disallow it? VAT on purchases, are we going to allow it or disallow it?
Disallow.
Disallow it.
It will be disallowed. It will be disallowed. So in these expenses, it is 3 expenses we are disallowing: depreciation, impairment charges, and VAT. So if you look at the solution, net profit, add disallowable expenses. Number 1 of them is depreciation. Number 2 is impairment charges. While number 3 is what? VAT on purchases. I will add them back to the net profit. After expenses, let's go back to income, revenue. On the area of the income, look at the first item we have. Profit on sale of assets. Is it taxable income or non-taxable income? You know, if you want to compute adjusted profit, add disallowable expenses, less non-taxable income.
Non-taxable income.
So profit on sale of assets, is it taxable or non-taxable?
Non-taxable.
Non-taxable.
It's a non-taxable income. It's non-taxable. Sundry income, is it taxable or non-taxable?
Taxable.
Sundry income is taxable. Anything miscellaneous income, other income, sundry income, they are all taxable. Do you understand? Another one, interest on government bonds. Is it taxable or non-taxable?
Non-taxable.
Non-taxable.
Interest on government security. What are the government security? Who can give me an example of government security?
Treasury bill.
Treasury.
Yes.
Bond.
Development.
Bonds.
Treasury
Development stock. Treasury certificates. All these things that are government bonds. If you collect interest on it, it is non-taxable income. So it is non-taxable. Do you understand? Another interest under our income that we have is interest from National Development Bank. Is it taxable or non-taxable?
Non-taxable.
Taxable.
Why?
Because the
Why
interest
is it
from government
non-taxable?
bank.
National Development Bank is owned by government, Abi?
Yes.
So
Yes.
it's supposed not to be taxable. But my brother, it is taxable. I will tell you why. The law, when he's talking about non-taxable income, he said interest from government security. Treasury bill is a government security. Development stock is a government security. Bond is a government security. So many like that. They are all government security. They are government security. But in the case of one of the government bank, like National Development Bank or Federal Mortgage Bank or Bank of Industry, you now go and put your fixed deposit. You go and fix your money in their bank. They are now paying you interest. Will the interest will not be taxed? It's going to be taxed because that one is not government security. You put your money in a fixed deposit. If you put your money in a fixed deposit in any of the bank, you collect interest, it's going to be taxed. Either government bank or private bank. So this interest from National Development Bank is interest from fixed deposit that we put our money, this company put their money in National Development Bank. It's going to be taxed. Do you understand? Do you understand?
Yes.
So it's going to be taxed. So the non-taxable income I have in this question is profit on sale of fixed assets, interest on government security. So let me go and compute the adjusted profit. In computing the adjusted profit, I had the salary expenses and now less non-taxable income. My non-taxable income, profit on sale of fixed assets and interest on government bond. At the end of the day, my adjusted profit for 2020 is 778,000. My adjusted profit for, somebody asked, does it mean interest on investment is taxable? Yes, it is taxable. It's taxable. My adjusted profit for 2021 is 760,500. My adjusted profit for 2022, 374,000. Why my adjusted profit for 2023 is 461,000. That is for Akorede Limited. I will do again. I will go and compute adjusted profit for Tope Limited by starting with the net profit. The net profit for Tope Limited for the first year, which is 2020, is 939,600. While the one of 2021 is 949,500. The one of 2022, 876,800. The one of 2023, 508,700. I will add back the salary expenses. Let's look at the expenses one by one. Which one is disallowed? Depreciation is a disallowable expenses. We all agree with that. Depreciation is a disallowable expenses. Another one that is disallowed. Repair and maintenance, is it disallowed or allowed? Repair and maintenance, is it disallowed or allowed?
Allowed.
It is allowed. Management expenses, is it disallowed or allowed?
Allowed.
It is allowed. It's for business. What of VAT on printing? Is it disallowed or allowed?
Allowed.
VAT on
Allowed.
printing, stationery and allowable expenses. So the only disallowable expenses I have in this question is depreciation. Let's look at income. Number one income I have, aside from gross profit, is sales of scrap. Sales of scrap, is it taxable income or non-taxable income?
Non-taxable.
Sales of scrap. Huh?
Non-taxable.
Why?
Because it will be treated without CGT, capital gain tax.
Oh, my brother, this is one of the way examiner convince students. Profit on disposal of fixed assets is non-taxable income. Abi? It is different from sales of scrap. Profit on disposal of fixed assets is a non-taxable income. It is different from what? Sales of scrap. Scrap simply means assets that don't have value again. Obsolete assets. Something that you're supposed to throw away. You now sell it. Is it taxable or non-taxable? No. Well, what I'm going to say is, If you dispose fixed asset, if you make a profit, it's going to be taxed. If you dispose fixed asset, if you make profit, it's not going to be taxed. Why fixed asset is not taxed is because of capital gain tax. But if you sell scrap, are you going to pay capital gain tax on scrap? Are you paying capital gain tax on scrap? Are you paying capital gain tax on scrap? For scrap, are you paying capital gain tax or you are not paying? If you sell scrap, government cannot ask you to come and pay capital gain tax on scrap. You can't pay capital gain tax on scrap because scrap is an obsolete material that don't asset that don't have value again. That even if you're supposed to throw them away, but profit on disposal of fixed asset, that asset still has value. It still have a value. So since sales of scrap is not subjected to capital gain tax, if you sell it, you will pay tax on it. You will pay company income tax on it. That means sales of scrap is taxable under company income tax because this is a company income tax question. This company will pay company income tax. So sales of scrap is a taxable income. Profit on disposal of fixed asset is a non-taxable income. Why? Because of capital gain tax. Sales of scrap is a taxable income. Why? Because scrap cannot be subjected to capital gain tax. If it's not subjected to capital gain tax, that means it's going to be subjected to company income tax. Do you agree with my submission?
Absolutely.
Do you understand the point I'm trying to raise here?
Yeah, we understand. But if that's the law, we agree. Otherwise, I don't agree. But then, if it is the law, we don't have a choice. We agree.
Okay. That is the law, my brother. And the law is scrap, obsolete material, unused material. You can't pay capital gain tax on them. It doesn't have value again. You have used them already. It's something that you're supposed to throw away. That is meaning of scrap.
I have a question, sir.
Yes.
Okay, so what if the examiner gives us a written down value for these scraps?
Oh, well, in tax, examiner cannot go to that extent of giving you a written down value. That means if a scrap have a written down value, it's no more a scrap. It still have a value. It's still useful. It's still useful. Do you agree with me? That scrap is still useful. If peradventure it has a written down value, that means it's no more a scrap. It's still useful. Do you understand?
Yes, sir.
That is the point we are trying to raise. So scrap is not subjected to capital gain tax. Rather, you are going to pay company income tax on this scrap. Do you understand? So sales of scrap is a taxable income. It's not a non-taxable income. Sundry income. Is it taxable or non-taxable?
Taxable.
Sundry income is taxable. Interest on investment, is it taxable or non-taxable? Interest on investment, is it taxable or non-taxable? It's taxable. Dividend received, is it taxable or non-taxable?
Non-taxable.
Non-taxable.
Dividend received is non-taxable. Because we treat dividend as what kind of investment? What
Frank
name do we
investment.
call dividend?
Frank investment income.
Frank investment income. So dividend is not taxable. Dividend is not taxable. Dividend is not taxable. So let's go and compute our adjusted profit for Tokyo Limited. Adjusted profit for Tokyo Limited. Add disallowable expenses, depreciation, less non-taxable income, dividend. For year 2020, the adjusted profit is 871,600. Why for year 2020? For year 2021, 888,500. For year 2022 is 806,800. For year 504,700. 504,700. That is for year 2023. We are done with adjusted profits. The second question said, what is the second question saying? It's saying that compute liability for the three company. The second question asks us to compute tax liability for the three company. Who are the three company? First, Akorede Limited. Second, Tokyo Limited. Third is who? Fine Beauties. So I will start from computing the tax liability of Akorede Limited. I will start from computing tax liability of Akorede Limited. If I want to compute tax liability of Akorede Limited, the first year given to us in Akorede Limited is year 2020. Abi? It is year 2020. And Akorede Limited normally ends its account when?
September.
30th September. Akorede Limited normally ends its account 30th September. That means the account will start 1st of what? The basis period will start 1st of what?
October.
1st of October. So for this 2020, the year of assessment will be 2021. The year of assessment will be 2021. So let's go and compute tax liability of Akorede Limited. For the tax liability of Akorede, the first year of assessment we have is 2021 year of assessment. 2021 year of assessment. 1st of October 2019 to what? 30th September 2020. Do you agree with me?
Yes, I agree.
Because that one, yes. Adjusted profit 778,000. The adjusted profit we computed. Are we giving capital allowance for Akorede Limited? No. That means my total profit is still 778. They will pay company income tax. Company income tax of 30%. 30% of adjusted profit. What will be the 30% of adjusted profit? Company income tax of 30%. What is the 30% of adjusted profit? So the 30% of adjusted profit is going to give us 233,400. And they will pay another tax called education tax. 2% of the total adjusted profit. Company income tax is based on total profit. In this question, adjusted profit and total profit are the same because there is no what? There is no what? Because there is no capital allowance. Can we all see that? Yes. So 2% of is going to give you 15%, 15,560. That is the education tax. As our 2021 year of assessment, the rate of education tax is 2%. Do you agree with me? Do you agree with me?
Yes.
Yes.
I said that earlier. Another type of tax that they need to pay, police development levy. As our 2021 year of assessment, there is no police development levy. Police development levy starts from 2022 year of assessment. So we move to 2022 year of assessment. For the 2022 year of assessment, 1st of January, 1st of October 2020 to 30th September 2021, the adjusted profit is 760,500. Why? The total profit will still remain the same, 760,500. In that case, the CIT is going to be 228,150. The TET will be 19,012.5. Then we start paying police development levy. Police development levy started from 2022 year of assessment. So police development levy, what is the rate of police development levy? Who can tell me?
0.005%.
0.005% of adjusted profit. 0.005% of adjusted profit. So the education tax, this education tax for Akorede in 2022 year of assessment is going to be at what rate? Is going to be at what rate? At what rate?
0.5.
At 2.5. For 2023 year of assessment too, is going to be at what rate? 2.5.
2.5.
Why for 2024 is going to be at what rate? 3%. Now we are done with 2022 year of assessments. For 2023 year of assessment. For 2023 year of assessment now. For 2023 year of assessment, for 2023 year of assessment, first of October 2020, 2021, 1st of October 2021, 1st of October 2021, to what? 30th September 2022. This 2023 assessment and 2024, we need to be careful. Why? Why do we need to be careful? The year of assessment of Akorede is supposed to stop in 2023 year of assessment. But it was extended to 2024. Why is it extended to 2024? Let's go to the question, because it's a cessation question. When does Fine and Beauty acquired Akorede and Toke Limited? When does Fine and Beauty acquire them? When does Fine and Beauty acquire them? At the beginning of the question, we were told that Akorede and Toke Limited combined their asset and operation to form a merger. in the name of a new registered company called Fine and Beauty PLC. It acquired the assets and operation of Akorede and Tope Limited. When?
37, 2023.
This 37, 2022 is the date of what? Date of
for
cessation.
Incorporation. Okay, so
and commencement for final.
Date of cessation for Akorede and Tope Limited. Date of cessation for Akorede and Tope Limited. If a company ceases operation, for you to determine the year of assessment, what is the rule? If you want to know the year of assessment of the company that ceases operation, what is the rule?
It is the year the company fails to make its account.
This date that they cease operation, for you to determine the year of assessment, you are going to add how many months to it?
6 months.
6 months. 6 months. This year that they cease operation, for me to determine the year of assessment, I'm going to add 6 months to it. If I add 6 months to this year, six months to 30th July 2023, what is it going to give me?
That'll be January 2024.
January 2024. That is the reason why the year of assessment of Akorede extended to January 2020, the year of assessment 2024. It's supposed to have stopped in 2023. Assuming you add 6 months to it, it's giving you 2023. That means you need to stop in 2023 year of assessment. In that case, it will be on actual year basis. But when you add 6 months to it, it's giving you 2024. That means the last year of assessment is going to be year what? 2024. Assuming you add 6 months to it, it's giving you 2023. The last year of assessment will be 2023. So let's go to the solution. I've determined my last year of assessment. For Akorede Limited, the last year of assessment will be which year? It's going to be which year of assessment?
24.
2024. You need to be careful here. If you add 6 months to it, it's giving you 2023. The last year of assessment will be 2023. In that case, it will be from the date of beginning of accounting year up to the date of cessation. So my 2023 year of assessment for Akorede, the 2023 year of assessment, 1st October 2021 to 30th September 2022. Why my 2024 year of assessment is going to be 1st October 2022, sorry. 1st October 2022. To what? To the date of what? To the date of cessation.
Okay.
Which, when is the date of cessation? 30th July 2023. Even the last account given to us in Akorede, you can see they said ending 30th what?
July.
This one is 12 months. This 2022 is 12 months. This 2021 is 12 months. This 2020 is 12 months. But this one is not up to 12 months. So in this 2024 year of assessment, from the beginning of the accounting year, which is 4th October 2022, up to what? 30th July 2023. Assuming when we add the 6 months, it's now giving 2023 year of assessment. That means we are going to stop in this year 2023. How do we stop in this year 2023? We are going to say 1st of October 2021 up to the date of what? Up to the date of what?
Cessation.
Up to the date of cessation. That means the basis period that this 2023 will give us, assuming when we add 6 months to it, is giving us 2020. The basis period that they will give us, it will be more than what?
12 months.
It will be more than a year. It will be more than a year. But since when we had 6 months to it, it's giving us 2024. That is what makes us to extend to 2024. Assuming I had 6 months to it, it's giving me 2023. And we stop in 2023 year of assessment. My basis period will now be 1st of October 2021 to 30th, let me give an example, 30th July 2020 what? 2023. That means the adjusted profit I will use here will be the adjusted profit for both 2022, this 2022, this 306, plus what? Plus the adjusted profit of the other months. This one that ends in July 2023. I will add the adjusted profit together because the basis period for these two periods fall within that 2023. Assuming, I'm just assuming it gives us 2023. But in this question, it gives us 2024. That means I'm going to stop this 2022. I will start another one from 2022 to the date of cessation. Do you understand? Do you understand? Now let's go and compute that liability of Tokpe Limited. For Tokpe, when is the accounting year end of Tokpe? Tokpe will normally end its account when? Tokpe normally end its account when?
31/6.
Tokpe normally end 31/6. Tokpe normally end its account 31/6. So when something ends in 31/6, that means it's going to start in when? It's going to start in 1/7. Do you agree with me?
Yes.
So for the year end 2020, the year of assessment for this year end 2020 is going to be year of assessment 2021. So, and it's going to start with 1st July 2019 to 30/6/2020. The adjusted profit is 871,600. No capital allowance. That means the total profit remains 871,600. Company income tax, 30% of total profit. Education tax, 2%. This one is 2%. Because as our 2021 year of assessment, we are using 2%. 2% of adjusted profit. Second year of assessment. Second year of assessment. What is second year of assessment? 2022. That one will start in what? 4th July 2020, Abi? And end in when? 30th
Yes.
June 2021. Do you agree with me?
Mm.
The adjusted profit of that one, we have already computed that too. 888,500. No capital allowance. Since there is no capital allowance, total profit remains the same. 888,500.
Okay.
Company income tax, 30% of 888,500. It will give you 266,550. Education tax, it will be at what rate? It's going to be at what rate?
2.5%.
2.5%. So that one, so education tax is 2.5% as at that period. Another one is development levy, 0.5%, 0.005% of adjusted profits. Somebody asks, is it net profit? No, it's on adjusted profit. 2023 year of assessment. That is the date of cessation. 2023 year of assessment. That is the date of what? Cessation. Both of the company, there's operation 30th July 2023. You add 6 months to the date that the 6 operation is still going to give you 2024. That means I'm going to extend it to 2024 year of assessment. I'm going to extend it to 2024 year of assessment. So for 2023, it will start with 07/2021 to 30th June 2022. You compute the tax. For 2024, it's going to start with what? For 2024, it's going to start with 07/2022 to what? 30th July 2023. How many months is this? Who can tell me? How many months is this? Because this is the last year of assessment. How many months is this?
13 months.
13 months. 13 months. In your last year of assessment, the basis period can be more than 12 months or can be less than 12 months. Do you agree with me?
Absolutely.
So the adjusted profit for that 13 months is 504,700. We compute the tax. The education tax rate we are going to use in 2024 is what? Is what rate?
3%.
Is what? 3% of adjusted profits. That is for Akorede Stopper Limited. Now, let's go to the other man, the new man that was just formed. The name of the new man is what? Fine
Fine and beauty.
and what? Fine and Beauty PLC. For the Fine and Beauty PLC, he commenced business when? When does Fine and Beauty commence business?
First
First of
August.
2023.
1st August 2023. And make up his account as follow. For Fine and Beauty too, we are going to apply. What rule are we going to apply for Fine and Beauty?
Commencement
Commencement
rule.
Commencement rule.
So let's go and compute. We are giving the adjusted profit for Fine and Beauty already. 1,005,000, 1,040,000, 2,520,000. Initial allowance, annual allowance we are giving. For us to get our capital allowance, what we need to do is to add both initial and what together?
Annual.
Annual together for each of the year. So let's go and compute the tax liability of Fine and Beauty. For the Fine and Beauty, the first year of assessment for Fine and Beauty, what will be the first year of assessment? Who can tell me? For Fine and Beauty, the first year of assessment will be what?
Commencement date to accounting year.
2024.
2024. Fine and Beauty first year of assessment will be 2024.
Yes.
It is what? 2024. That will be the first year of assessment, because the first period given to us is 2023. The basis period will be from the date of commencement. When is the date of commencement?
1st of August 2023.
1st August 2023.
So when?
31st December 2024.
To 31st December 2023. We are giving adjusted profit 1,500,000. There is no capital allowance carry forward. But capital allowance for the year is 730. Who can tell us how do we get the 730? Capital allowance for the year, how do we get the 730?
Initial allowance plus annual allowance.
Initial allowance plus annual allowance. If we add the two together, it will give you what?
Initial allowance.
730.
It will give you 730. No. Going back to the Fine and Beauty is not a manufacturing company. It's a trade. Look at the capital allowance available, 730. This capital allowance is too much. What are we going to test for? When you have too much of capital allowance, what are you going to set for? For trading and service company, what are you going to test for?
Minimum tax.
Huh?
Minimum tax.
When you have too much of capital allowance,
you restrict it to 2
what are
over
you
3.
going to test
2
for?
over 3 of
You are
accessible.
going to test for restriction of capital allowance. That means you are going to restrict the capital allowance to 2 over 3. Abi?
Yes.
2 over 3 of what?
Adjusted profit.
Of adjusted profit. In this question, my people, 2 over 3 of 1,005,000 is giving us how much?
70.
670. 670. Since 670 is less than the actual capital allowance, That means I cannot claim actual capital allowance. Abi?
Very.
670 is less than the actual capital allowance. The actual capital allowance is how much?
730.
730. That means the capital allowance I'm going to claim for this period will be what?
670.
670. The difference between 730 and 670, what will happen to that?
Carry it forward to the next period.
The difference, 730 minus 7, it should be 60. This
Difference.
will be allowance carry what?
Carry forward.
Carry for the next period. My total profit, if I want to get my total profit, what am I going to minus to get my total profit?
Minus 670 from 1,500,000.
Adjusted profit, 1,005,000, Abi?
Yes. Minus 670.
Minus 670. Because the capital allowance we claim is 670. If you minus 670 from 1,005,000, it will give you 335. So
Hello?
the 330.
Hello, sir.
Yes,
Please, sir.
I can hear you.
Do
Ask
we
your
know
question.
that capital allowance is more?
Huh?
I said, please, when do we know that capital allowance is capital much that we should apply to 3% on it?
Well, anything you are computing, you want to remove the allowance. You can't, without writing it, you can test for 2/3. If the 2/3 of it is less than the actual capital allowance, that means you need to restrict. All the time, you can be testing for 2/3. When we can know is when you have too much of capital allowance against the profit, or when the capital allowance is more than half of the profits. Look at the capital allowance, 730. Adjusted profit is how much? 1,005,000. Half of adjusted profit. How much is half of adjusted profit? That is 500,000 25. Abi? That is half of adjusted profit. When capital allowance is more than half of adjusted profit, you should know that in this question, there must be a restriction.
Thank you,
But
sir.
for you to be on the safer side, all the time, before you remove capital allowance, test whether I'm going to restrict or not. Assuming in this question, if 2/3 of my adjusted profit is higher than 730, that means I will not restrict. Do you agree with me?
Okay, sir.
Yes.
That means I will not restrict. If the 2/3 of this adjusted profit is higher than 730, I will not restrict. I will claim all the capital allowance. Restriction is not applied. However, another thing we need to understand on restriction too is restriction does not apply to two companies. What are the two companies that we don't use restriction for them at all? Who can name them?
Agro-allied companies and
Agro-allied.
manufacturing companies.
And manufacturing company.
Have that in your mind. Anytime you are computing adjusted profit for any company that manufacture good, you don't use restriction. No, you claim all the capital allowance. Do you agree with me?
Yes, sir.
Okay. So let's compute the tax liability. CIT, 30% of total profit, 30% of 335,000. It will give us 100,500. CET, education tax. That one is 3% of adjusted profit. What is 3% of adjusted profit? Somebody should help me check. Is this my own correct? 3% of adjusted profit. That will give us how much?
500. That's one.
Huh? 3% of adjusted profit.
150.
30.
Yes, 150.
So that means this is not correct. I have to go and change this. 3150. Police development levy, 0.005% of adjusted profit. That will give us how much? (0.005% of adjusted profit. That will give us how much? Somebody tell me. Huh? That is how much?
50.25.
6 what?
50.25.
0.25. That is the correct answer.
Please, sir.
Yes.
This police development fund, do companies actually pay it?
Eh? I can't hear you. Now, can we go to the second year of assessment? Hello, I can hear you now.
I said this police development fund, do companies actually pay it? Do companies actually pay this police development fund?
Yes, they pay it. They pay it.
Sir.
The second year of assessment, 2025. That is the second year. 2025. For the 2025, the basis period is going to be 1st of January 2024 to what? 31st December 2024. The adjusted profit will be what? 1,040,000 is given to us in the question. Mind you, the capital allowance we carried forward for last year, that's 60,000. We are going to brought it forward. Abi? Do you agree with me?
Yes, sir.
Now, the capital allowance for the year, this second year, what is the capital allowance for the year? Let's go and see the question. Where is the capital allowance for the year in this second year? 710. They only have annual allowance, 710. 710. I will also test for restriction again. I will test for what? Restriction. This restriction, 2/3 of 1,040,000. What is the 2/3 of 1,040,000?
93,333.
Eh?
333.
6 what?
693,333.
That means I'm going to restrict. This is the capital allowance I'm going to use. So for me to get the capital allowance carry forward, 60,000 plus 710, that is 770. 60,000 plus 710, That is 770 minus 69333. That means my capital allowance carried forward is going to be how much? 76667. Do you agree with me? Seven six 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 seven. That is my capital allowance carried forward. In that case, my total profit. How do I get my total profit? Adjusted profit minus the capital allowance relief. 1,040,000 minus 69333. So my total profit is going to be what? 346,667. 30% of 346,667. How much is it giving us?
104,000.
How much is it giving us? Huh?
104,000.
104,000. Is this correct? Is this correct? Is it
Yes.
correct?
Yes.
3% of adjusted profits. What would be the 3% of adjusted profits? The 3% of adjusted profit. What is the 3%?
200.
Can you call it again? 3% of adjusted profit is what?
3,120. Sorry.
That's 1,200.
31,200. Zero 0.005% of adjusted profits.
52.
52. That is for the second year of assessment. The third year of assessment. What is the third year of assessment? The third year of assessment. What is the third year of assessment? 2026. The basis period will be 1st of January 2025 to 31st December 2025. The adjusted profit given to us is 2,520,000. Mind you, we have capital allowance carried forward that we brought forward in 2026 year of assessment. That is what? 76667. Do you know how we get this? It was the one we carried forward last year. We now brought it forward this year. Do you understand?
Yes.
The capital allowance for the year in this third year is 640. How do we get the 640? If we go to the question under fine and beauty, under the fine and beauty, we have initial allowance 300, annual allowance 340, sum of the two, giving us what? 640. That is what is giving us.
Hello, sir. Hello, sir. Please, sorry for taking you back. This police development levy, I thought is levied on the net profit.
It is levied on adjusted profit. Oh, that is what is levied on, not net profit. Adjusted profit. If you study the tax pro mass of FRS very well, they deduct it on adjusted profit.
Okay, so is it the NITDA that is now on the net profit?
Yes, NITDA is on net profit. I agree with you. NITDA is on net profit. Now, the capital allowance, my ladies and gentlemen, 2/3 of 2,520,000. How much is the 2/3? The
1
2/3,
million.
how much?
1,680,000.
If you add 76,667 together with 640, it will give you 716,667. Since the 2/3 of the profit is higher than it, I cannot restrict. I will claim all the capital allowance. Do you understand my point in this third question? In this third year?
Yes, sir.
The 2/3 of 2,520,000 is almost 1 million. It's higher than the capital allowance available. How much is capital allowance available? Both the brought forward and for the year. If you add the two of them together, that is 700,667. If you look at the 2/3, it's higher than it. That means I'm not going to restrict. I'm going to claim all the capital allowance. Do you understand why we did not restrict here?
Yes, sir.
So there is no restriction here. All the capital allowance available we claim. So my total profit will be 2,520,000 minus 700,667. So it will give me 1,803,333. So CIT, 30% of total profit, 30% of 1,803,333. How much is it giving us?
540,999.
5.
That's 541,000.
Okay. Is this correct?
Yes, sir.
My education tax. How much is my education tax we give?
75,600.
75,600. My police development levy, how much is it going to give?
126,000.
126.
2,600.
Huh?
It's fine. Okay.
7 like this. Is this correct?
No, 2,600.
I can't hear you very well. 122.
126. 126.
So that is it on this question. We have done with this question. So examinable question 2 is theory. Please, let's take our time to study the examinable question 2. Let's understand it. The solution is there. Examinable question 3 is a case study on merger and acquisition. You understand? Please, let's take our time and study it too. It's very important. This examinable question 3 is a case study on merger and acquisition. Let's take our time and look at it and study it. We have another one, examinable question 4 too. We can take our time and look at it. So thank you for having me.